Hey everybody, Marty Mazur here. It is after hours on Thursday, the 14th of September 2023. This will be your end of week market snapshot. Tomorrow or over the weekend, I'm going to bring you your economic update. There's a lot there to go over, a lot I want to go over with you. So I thought I would completely separate the market snapshot from the economic snapshot this week. And I'm going to do it a little differently. Feedback that I've been getting actually for a very long time is that these videos are a bit much to take, frankly, to take in. And I know that really speaks to the technical analysis. Now, there are a handful of you out there who have said that you really enjoy those technical analyses. So I don't want to stop doing them. But particularly with clients, these are the ones who are mentioning this to me, or certain clients, there's some clients who like the technical analysis as well, is that, it's just so far over my head. It's just kind of gobbledygook, and you need to make it easier to understand. I really don't know how to do that on the technical analysis, but one thing I've said to people here recently is that, I get it. If you stick till the end, you'll get the general gist in my parting comments. But, it's kind of torturous to stick to the end and just look at something that just doesn't make a lot of sense to you. So I'm going to reverse it. And what I'm going to do is give what would normally be the final message up front with stuff that I know everybody will grasp. Whether or not they find it interesting, is a whole other story. And don't get me wrong, it's just that we all have our specialties, right? Professionally, recreationally, and so forth. And mine are very limited. If we're not talking markets, the economy, fishing, and maybe basketball, I guess in that order, I'm pretty dull, or I should say I'm not much use to you in that conversation, honestly. So this is not a criticism of anybody. This is just something that's not of interest to a lot of people, and we are so grateful that we have so many clients who just trust us and been with us a long time, and we've ridden through market cycles, and they get it, or at least they get that we do what we do, and we do it carefully. Now, my desire to communicate to you, particularly during times like these, is high. I mean, it's very compelling for me to reach out, particularly to clients, and say, what I'm saying and what I'm thinking at times flies in the face in the price action of the markets. And that's when I'm really compelled to reach out and tell you why. It's not always the case. Those longtime clients have known us to be very, very bullish. We have clients all the way back to the 80s. So yes, during the 90s was a wonderful period to be bullish. We did start getting careful in the late 90s. We got very bullish in the early 00s. We got careful again to some degree 07, 08. We just kind of rebalanced our way through that and did relatively well. And then after experiencing the 08 Great Financial Crisis, as most of you know, we've created our own slew of indicators, and it's just really organizing and then scoring data that we've been tracking for years. Worked very hard at our education around using derivatives to hedge portfolios, and that was a wonderful thing during the COVID sell-off. So what I'm going to do is I'm going to make that final message up front. The last two slides tonight will just be a quick technical look for those of you who are interested in that. So folks, the chart in front of you may look somewhat jumbled, but I can make sense of this one. These red shaded areas are recessions going all the way back to 1963. So I went exactly 60 years back. And the line here is the S&P 500. I should have gotten rid of these moving averages, but too late now. Those are the colored lines. But just this group of lines here represents the price action. The smoother one is moving averages, but the price action in the S&P 500. And as you can see, I calculated here with a tool the percentage declines in the stock market during these recessions, and there were 6 or 8 of them going back that many years. So the key here going forward, I think, in terms of if this bear market does indeed have another leg down, would be, is there going to be a recession going forward? And our view is that odds definitely favor that. Therefore, hedging the portfolios, staying very diversified, having things like gold, having lots of cash, which we're using in short-term treasury, money market fund that's paying north of 5%, so it's a nice time to be in cash, and just very, very diversified. And in our U.S. equity exposure, making sure things like staples and healthcare are top holdings in there. So that's a kind of a defensive portfolio, and we're not disappointed in our year-to-date returns for people who are fully invested in our core, but we just do not see an edge or a good RR, risk reward decision in going long, say, equities the way we were for the most part through here up until about August 2019. How we were in a big way. We had a really good run from here to here because of our non-US exposure along with our US equity exposure. And and again, through here, I started my career essentially right here, 1984. So here's my point for this chart, is that stocks tend to peak, from what I understand, on average about a couple months prior to recession. And you can see sometimes it's right during the beginning of the recession. So apparently over a long, long period of history, about 2 months before recession, the market peaks. So in addition to our own tools, we pay for some of the best research in the world. One of our research partners believes the recession is coming in the fourth quarter. And if they're right, the market's about to peak using historical norms. Another analyst who I just listened to before this presentation, they've got the recession out in the first half of 2024. Therefore, they think there could be more upside to finish out 2023 in stocks before we get the peak and the next leg down in the bear market. So does history support the notion that there's another leg down in this bear market if there's a recession? The answer clearly, I think, is yes. So here's the recession right here in the first recession in the early 70s. You can see the first one brought stocks down by 36%. And by the way, and this gets a little tight when you go out this long, but this is what I would call the first leg down, right? Here's the rally where it looks like at least half of that was retraced. And then here's the recession, and here's the next leg down, right? So here we are in the soon after recession, and this was that big 73, 74 bear market, okay? And here we were, market peaked before recession, right? Came down. That you could say that was maybe the first leg. Looks like about a 40 to 50% retracement. Next leg, somewhat of a retracement. Last leg, and call it 50%, 48% decline. And then we had the 80s, right? So we had the market peak, and then the market actually rally hard into the first early 80s recession, and then only gave up an 18% decline, but then just a few months later peaked just before the bigger recession, came down, first leg down, had a little bit of a retracement, second leg down, and we're down 27%, peak to trough there. By the way, both of these are what the Fed has said that they desperately want to avoid, are these back-to-back situations. This one in particular was really characterized by Fed chairman at the time, Paul Volcker, has a reputation for having been very aggressive. We had, super high inflation back then, and sure, he got aggressive with interest rates, and then, frankly, he and his team panicked. I mean, he's got a reputation of having nerves of steel, but history doesn't really support that. And so they cut rates when they essentially, some would say, forced that first recession. Inflation came roaring right back, and then boom, we had a serious recession there. So this Fed has said they don't want to do that. They don't want to do that. Well, we'll see. Actions don't necessarily suggest that they're not willing to take that risk. So here we have kind of that brief early 90s recession. More or less peaked a few months before, came down, retraced all of it, frankly, maybe even a little more, and then, saw a 20% drawdown. Then we had that really nice, internet bubble, really blowing up here in the late 90s. We had that 98, call it a correction. Intraday, it was 20%, but not quite on closing basis. This was quite a period in here. I do remember it quite vividly. Russia defaulted on its sovereign debt. Biggest hedge fund in the world went bust. Long-term capital management. Asian currency issues in there as well. And but we came out of it. And then peaked just a few months before the recession, the tech bubble. It was a very narrow recession, but a massive bear market. This is the S&P. The NASDAQ went down over 80% during that time period. First leg down, nice retracement. Next leg down, big retracement. There were 40% retracements off of some of these levels. And then kaboom, finally March of 2003, the market bottomed, struggled with it a while. And this is where PWA had one of its best runs on a relative basis because of our global attitude toward things. And then here we are. I say PWA, pre-PWA, but my career back in the in Princor Financial Services, but managing money for. We still have virtually all those clients today. And then here we are, right prior to, we created PWA about right here. But we're getting out of anything real estate and mortgage related. It's just the impact all that had on the general economy that caused a 57% decline in stocks over an 18-month period, right? First leg down, nice snapback, people start getting bullish, and then, kaboom, right? So moving through there, lots of close calls, right? That was about 20%, but it's not an official bear market if it's not on a closing basis. That was 16%. This was 20% intraday, but not quite on a closing basis. And then the COVID phenomenon, which was interesting because and I'm going to show you another illustration here in a second, but our recession indicator started flashing here. I did videos out the wazoo. I said, folks, we're going to start being defensive, but don't be surprised if the market doesn't melt higher, because the data that is telling us to be defensive is going to tell the Fed to start printing money. Well, the Fed did, despite the fact that they said they didn't see a lot of risk. That wasn't true if you read their own economic reports. And then COVID hit, and should have been a doozy because of the corporate debt dynamics at the time. Fed did something it wasn't supposed to do. The Federal Reserve Act unequivocally says they can't buy corporate debt. That's exactly what they did. And trillions of dollars later, and they created this expansion in here. And then January 3rd, 2022, the S&P peaked, NASDAQ a few months before that. And right in here, folks, many of you will recall, we actually said 3,500 is our downside target. That's exactly where it hit on October 16th, and it bounced off of that. And I actually said we'll be buyers of stocks there unless our recession indicators are flashing. By the time we got there, they were. And as you can understand why, when I look back at history here, that if we have a recession, we believe there's another leg down that'll likely take us down below that 3,500 mark. So really the big question is there going to be a recession? So we'll talk about that as well. So again, this right here, I could probably stop this presentation. I can tell this is going to take a little while, but would explain why we want to be hedged right here and be very, very diversified. Yeah, we've been doing okay, but we've got some protection on so that when this happens, of course, we'll take a drawdown, but we don't want to take what the rest of the world is going to take, just like we did here. We were hedged here because of our assessment right here, and we captured, just really a fraction of what the market did for clients, and that was a good thing. Okay, so next one, I can't go back any further, or I would. With Bloomberg, we only have this back to about 1990. So this is the price to earnings ratio for the S&P 500. And all I'm showing you here is these are bear market lows. This wasn't a bear market, or I'd have a circle there. So bear market low. This is the price to earnings ratio for the S&P 500. So notice where it was when the bear market bottomed and a new bull market began. Okay, and notice where it is now. And I bet if I went back historically, if I could, this would be the highest PE probably ever that a bear market actually ended on. So I'm skeptical based on price to earnings. Now, price to earnings, frankly, can be very manipulated. In fact, companies, I can give you examples, we'll do that another time maybe. Big companies are doing it big time right now because, as one of my favorite macro analysts, Julian Brigden, said here, not too long ago, today's CEO has become nothing but a shepherd of his or her stock price. And man, are we seeing that in some of the action. And it's great if you're a stockholder, at least in the short run. Ultimately, fundamentals are going to win out. So here's price to sales, which is obviously much harder to manipulate. I mean, revenue is what it is, and you can see where it has bottomed. You can see how high it was, where the bulls would tell you that the market has bottomed. So this would be a first, and could be if we're actually off and running and we have a sustainable bull market ahead. It's coming off of a relatively high valuation, actually a very high valuation point. Okay, so will there be a recession? And we score 47 inputs. I'll be doing that tomorrow, every single week, and we score it, and I show you what it looks like. You can do this all by itself and make this your indicator. This is the ratio of leading economic indicators, what's expected, say 6 months out, to what's going on right now, coincident economic indicators. And I've drawn this line right where it is currently. And as you can see, we've never been at that line without being in or entering into or in close proximity of a red shaded area, which is a recession. And I just showed you what stocks tend to do coming into those red shaded areas, right? So, and here we are right now. So this will be a first. This goes back to 1960. That if we're in this area and we don't see one of those red shaded areas, we'll chalk that up as the one time, at least in the last 60 years, where that didn't signal that a recession was looming. This one is a technical analysis, and what this one is, it's slower moving, weekly moving averages. So the orange down to the blue line are the 20, 30, 40, 50, and 60-week moving averages. Now, when the shorter term, faster moving averages are on top, that's a bullish sign. Momentum is strong. So when they all line up this way, which by the way they do right now, that is a bullish technical signal. So we want to respect that. Right now, this tells us the technical picture for the S&P 500 is bullish. The problem is that the macro outlook is bearish. The macro outlook says that one of these red shaded areas is probably coming. And if it comes, then this is going to roll over relatively quickly. So June 17th, I believe it was, is when we created the PWA index. So right in here. And then we went and back tested it at key, points, key inflection points, for a while back here. You can see all the way back here to 1995 and points in between. But I use this here just to show you where the index was scoring or what it was scoring when either these things were rolling over or when they were rolling back up. Okay, so prior to the tech bubble bursting, we had 1995, 1996, 1994. Bonds had a horrible time right in there. I remember managing through that. But the PWA index was scoring pretty well right when things were ramping up. So this was a good time to be in the stock market. So here's that 1998 period that I talked about earlier with Russia, etc. Rolling over, but our index says stay the course. Here it was rolling over, getting really close, but our index right here said stay the course. Right here, while the moving averages were still lined up bullish, our index rolled over to a 29.41 just a few months before the market fell out of bed in a monster way. Here's our index bottoming right when this was getting better, right? Here's our index topping just before all hell broke loose during the great financial crisis. This was nearly a 20% decline, European debt crisis time, right? But we were still net positive, said conditions were not recessionary, and we came right out of it. Here was that 2015-16 period. I remember it was nauseating, 2 years pretty much flat, but 16% declines in between. But never did our PW index say to abandon your long-term bullish equity allocation. Here was that, call it 20% decline in 2018, got a lot of people scared. There was a lot of reasons to be scared. Clients, some of you will remember, we had a lot of conversations around that time. I said, this is a correction within the context of an ongoing bull market and expansion. Sure enough, we had a really good run. Then here we are, August of 2019, all-time highs. Same person who told you to stay the course here is saying, we're going to start hedging. We're going to start using what we learned, hedge at that time with an options collar. And thank goodness we did, because we had clients, when their friends were panicking, they weren't, because we did okay. Where we could have done better is if we loaded up the truck right in here. Of course, if we could do it all over again with what we know now, we would. Of course, again, our index was telling us we can go longer than we were. Reason we didn't go in like we would, and like we did here, and like we did back here, and so forth, and like we stayed in here, is because of all the artificiality and so forth. It's like, they can buy corporate debt and rescue their friends in the hedge fund and private equity businesses, but Pier 1's still going out of business, right? So we didn't get more defensive. We added commodities right in here, which have been some of our best positions. So we actually did do some things that made sense relative to the macro. But then here we are, beginning to roll over, and right about at the peak, boom, we're back in the red. Okay, came down, first leg of the bear market, maybe the only leg, but right now our view is the first leg. Why? Because we're still scoring, notably negative in our overall macro indicators. So this says that this is not to be bought at this point, because this says that odds favor a recession, and if we get the recession, we should expect another leg down in the bear market. So folks, I will leave that part there. So that is me basically telling you, hey, price action says this, looks pretty bullish, at least on this technical indicator. I'm going to show you, those who stick with me, a couple more here over the next few minutes. But it's not that, it's this. It's that conditions right now tell us that there's, my analogy lately is there's a 50% chance of a blizzard high on the mountain, and we don't want to go to that elevation as long as that blizzard warning is there. When that abates, we'll start climbing, or when the storm hits, as it abates, we'll start climbing. So either way is fine with us, as long as we're not climbing a super high, risky mountain when there's that storm warning, or at least when we have that storm warning on. So those of you who have no interest whatsoever in looking at the NASDAQ 100 and the S&P chart, this would be what I'm talking about. Thank you so much for sticking with me that long. I really hope that was helpful. Any feedback from those of you who tell me this is just not fun to stick through these, let me know if that was better for you. Okay, so for the rest of us, and I took so long here, I'll just take another couple minutes. The first one is the NASDAQ 100 ETF. It keeps succeeding with that test of the 50-day moving average, bounced successfully off of this this trend line off of the January low, but there's just really nothing about the momentum here in either of our favorite indicators that says that there's much to buy or to jump onto right here. Could very well happen. This could change, but it's going to be quite the rally to make that technical picture look bullish right here. And then on the S&P 500, we actually recaptured the 50-day moving average that we weren't doing, so that's very bullish, and closed just a hair above that 4,500 level right there on the S&P. So we'll see how things play out tomorrow. Really interesting, I got to tell you, because CPI came in a little bit hotter than what consensus expected. Retail sales on the surface did as well. You look at revisions and then you adjust for inflation, not so much. But yeah, the market did what it did. Our friends in the option space tell us that this has a lot to do with options expiration and flow and what dealers are having to do to hedge their exposure. And they suggest that this actually could last, through the end of the year. But they do kind of go back and forth. A couple of weeks ago, gamma was very negative. So we're not putting a tremendous amount of weight on that, but it could be explaining some of these strange days like we had today, and short covering rallies and that sort of thing as well. Again, though, when we consider the technical analysis that we do, that has been really good for us in the long run, getting to a new marginal high, could very well happen. You can see we're getting real resistance off of this trend line that began in March. I would suspect that if we do get a rush up here over the next few days, that it may not be able to make it there. If I were a short-term trader, I'd probably short or add to my shorts right in there if I were thinking that this market's going to roll over, because you're just not going to get the momentum, and you're probably going to get overbought in here very quickly on the RSI. So folks, again, despite the action, it's better than I thought it would be here for the first half of September. Once again, our folks in the derivative space say that a lot of that is just because of this positioning, and there was a lot of people betting on a big September swoon. The fact that it may not happen, they're freaking out. It's forcing the hedges to get covered, dealers to do their thing, shorts to get covered, and so forth. So we'll see how it plays out. Right now, this situation, as I've illustrated in this presentation and all the others, says that good diversification and some form of hedging is very prudent right here, and very, very justifiable if you're a long-term investor and who wants to manage their risk well. Thank you, as always, for watching and listening, and be back in a day or so with your economic update. Take care. Bye-bye.